we have a further 3 options that are going to see us acquire more insurance. So the 6th option we're going to look at is called paid up additions. Paid up additions are kind of a neat idea. Here, we can once again work with this idea that we have a whole life policy. Let's say it's a $100,000 par whole life policy. And let's say it pays a dividend. So we take that dividend and we're going to use it to buy a paid up addition. Remember I talked before about a 10-pay or a 20-pay whole life policy where you'd have a very abbreviated premium schedule and then your policy is paid up and no more premiums have to be paid? Well, we're going to do something similar here, but this time it's a 1-pay whole life policy. And what I do is I take my dividend and I buy just a tiny, tiny little whole life policy. This new whole life policy is typically going to have a fairly small death benefit, but it's also going to be a par whole life policy, which means that next year, if there's a dividend, and keep in mind usually there is, so next year if there's a dividend, I'm not going to have 1 dividend, I'm going to have 2 dividends. Now I'll have 1 large dividend and 1 small dividend, but I'm going to take those 2 dividends and I'm going to use them to buy another tiny little paid up whole life policy. So what I'm doing here is I'm increasing the amount of insurance in place. These extra policies are paid up, so I'm not increasing my premium requirements, I'm not increasing my cost of insurance, and I'm building up this pool of investments. If I want to take a policy loan later on, I have this policy, and this policy against which to borrow. When there's going to be a death benefit paid out, the death benefit will be based on this policy, and this policy. So you get to the 3rd year now, and in the 3rd year you have this initial whole life policy, you have this little guy here and this little guy here, and we're going to use all of those to buy another little par whole life policy. So given enough time, you'll see something like this with your par whole life policy. In fact, if you buy this policy on a young child, you can get into situations where eventually you're buying paid up policies that are more than the original death benefit associated with the policy you acquired for that young child at a young age. Paid up additions are generally appropriate where we have a long time to compound. We have a long time to build up that value. For people who are a little bit older, it's probably too late for paid up additions to be really valuable. Special term additions, like I said, are typically used where we have a need or a want to have a death benefit that's equal to the face value plus the cash surrender value. And typically this comes about because of a client's perception that they want to make sure they get back what they put into the policy. Term additions would be used where we want to sell somebody, we have a needs analysis that says, I need $200,000 of life insurance, but they can only afford a $100,000 par policy. Well, you might go other routes, but one route you might go here is you might purchase that policy with the term additions. Your needs analysis shows $200,000 of insurance is needed, so we buy a $100,000 par policy. We know that the insurance company might provide another $100,000 of term coverage. That's our $200,000 death benefits. The savings options are typically used where the client feels that the par policy will help them to build a pool of savings. Often they look on this as kind of an unconscious pool of savings, something that I don't have to dedicate any money to. I'm already paying my premiums on my whole life policy. Now, as an added benefit, I'm going to build up some savings. Cash or check, this is sometimes done by parents buying policies on their young children. They'll choose this option, and then they'll allow that young child, when they get to adulthood or whatever the case is, to start using that money to fund maybe an education or what have you. So there's different reasons why we would choose cash or check. Maybe just the policy owner looks at the history of paying out dividends and says, you know, I'm willing to take that risk. I think most years it'll benefit me to have the par whole life policy. The cash or check that I'll get will be more than my savings if I chose a non-participating policy. Now, there's still one more option, and that is we can just take that premium, take that dividend, and we can use it directly to reduce our premiums. So when we take that amount, we just directly, bang, reduce the premiums, and it gives some savings out of the checkbook for the year. Now, without getting into too much detail here, because we haven't talked about taxation yet, I will show you that when there is some cash associated with a participating whole life policy, as in the case of the first three options, possibly as in the case with the fifth dividend option, and in a sense, although less directly, with the reduced premium options, when we have that dividend paid where there's a cash component or some cash savings to the policy owner, then there are some tax implications for having done so, in the form of a reduced adjusted cost basis for your life insurance policy. We'll talk about that more in a future video when we specifically talk about taxation of life insurance. Now that we've looked at all the features of whole life insurance, I just want to spend a minute talking about who buys whole life insurance. The price for whole life insurance is typically quite a bit higher than a similar amount of coverage for, say, a term life insurance policy, which must lead us to say there's got to be a reason why people buy this thing. Well, there are some good reasons why people buy whole life insurance. Whole life insurance generates excellent savings. The savings or the investment returns are guaranteed in the policy owner's hands. So people look at whole life policies, they say, you know what, that's a nice, stable, guaranteed investment. I don't want to take any chances with my life insurance. Maybe I will invest here and just allow this thing to grow. It's going to cost me a little more money than it would to buy the term insurance that I could buy, but I know it's always going to be with me this way. Whole life insurance is a great estate planning or estate preservation tool. If you have a client who comes to see you, maybe an older couple in their 60s or 70s, and they realize that they need some insurance to pass on an amount to their kids or to their grandkids or to a charity, then a whole life policy can accomplish that very well. Term insurance is not really good for those folks. Term insurance has a limitation, of course, that it's going to run out at a certain age. If they buy a term insurance policy at that late stage in life, it's likely that it's not going to last long enough for them to actually use the policy, whereas whole life insurance is going to be with them for as long as they live. Some folks buy whole life insurance because they like the tax-deferred growth opportunities. Remember that the policy reserve grows on a tax-deferred basis. Some people would buy whole life insurance specifically because they want to take advantage of one of these features. Paid-up additions on policies purchased on the lives of children is a common example of that. Some people would buy whole life insurance because they want that permanent insurance and they want something that's not going to require a lot of management on their hands. You know, when you buy a whole life policy, your only real commitment here is to continue paying premiums. So whole life insurance, it is a little bit more expensive than, say, term insurance. It's certainly not the cheapest product that's out there, but it has lots of great features built in. It can do all kinds of things to adjust to you. You'll recall from back in Module 3, you talked about non-forfeiture options. Well, whole life insurance boasts powerful non-forfeiture options. We can use extended term insurance. We can use reduced paid-up insurance. And we can also use an automatic premium loan in the case of a whole life policy, all of which can keep coverage in force long after premiums are paid. So when you're sitting down with a client and they have some cash flow available and they're looking for maybe some tax-deferred growth or some good collateral later on, consider whole life insurance. It's a fantastic tool. It's often overlooked today, and it should not be. If you had a client to whom you had sold a whole life policy in 2005, and I stand here in 2010, that client would be singing your praises today. They would not have seen their investments suffer as lots of other people did during this time. I'd like to thank you again for joining us for this portion of the series. Hopefully you have a great understanding of whole life insurance now. This is a fairly heavily tested topic. You absolutely have to understand this both for exam purposes and most likely for your career down the road. Thank you very much. Enjoy your continued studies.